Welcome back to Trading with CJ. Now, we hear a lot of people talking about stocks to buy now or stocks that have potential growth, but I'm going to flip that on its head and talk about some stocks that I think you should avoid. Stocks for me that are awful buys. Now, it's not a very fun one if you do own any of these companies, however, they're not your typical popular stocks, so hopefully you haven't gone all in on these. But with that being said, I'm not a financial advisor and this video is purely for entertainment purposes. Just because I don't think these stocks are very good, you might end up seeing some potential. So it's important you always do your own research. Now I want to thank everyone for the growing support, and if you can leave a like and subscribe to my channel, that is greatly appreciated. So I've got 5 companies for you today that I'm going to mention, so let's get straight into it. So the first company up is a company called L Brands, ticker symbol LB. This is a US stock and it's in the retail sector. It's got 2 main segments. One is its Victoria's Secret, which is a women's fashion and underwear brand, and the other is Bath and Body Works. Bath and Body Works is actually doing okay, but Victoria's Secret is failing miserably. Let's take a look here at its 5-year graph. It's just abysmal. It's been decreasing year after year, and it has an average annual return of minus 29.2% per year, which is just atrocious. And 5 years ago, it was worth $100 per share, and it's now worth $15 per share, and that's just decreasing all the time. If we look at its debt, it has a huge amount of debt. It has a debt to equity of 296%, which is just massive. Not to mention, this company is also making a loss of minus 5.9% profit margin at the moment, which will probably increase as well. If we talk about a little bit of news on this company, they tried to sell 55% of Victoria's Secret. The deal was on. The stores all closed due to the current global situation, and then there's been a lawsuit between the 2 companies, and on May the 4th the deal was off. So they are in really tough times, and it's very speculative times for this company and its shareholders. It has huge amount of debt, it's making a loss, and it has a decreasing share price. It's a no from me. So the next one up, my mate actually alerted me to, because he bought into this company and it's not done very well. It's just been falling ever since, and that is Ted Baker, Epic code TED. It's a retail company again, and it's a bit of everything. It's got fashion, footwear, fragrance, etc. And once again, looking at their 5-year share price here, it has been atrocious. It's just been decreasing year after year. You can see it hit highs of £35.50 and now currently trading at 79 pence per share, and that is still continuing to decrease as we speak. Over the past 5 years, it's had returns of negative 38.8% per year, which is just huge. And even at 79 pence per share, that is still predicted by analysts as overvalued by 78%, which is just huge. And it's also predicted in the next 1 to 3 years as having 0% growth. It will probably continue to decrease. And if we look at its profits, it's not making any. Negative 11.2%, and it has a high debt of 121%. They have tried to raise money over the past few months, and they have done so. However, with profits decreasing and the debt increasing, this is not a long-term buy for me, and I won't be surprised to see this one go under. So the next one up is another US stock, and this is GameStop, ticker symbol GME. It's a video game retailer. And following on with the theme, the 5-year graph is atrocious. Look at this, it's decreasing year after year. It did hit highs of $47.44 per share, now trading at $4.30, which is a huge difference. It has an average annual return over the past 5 years of its earnings of negative 62.4%, which is just huge. It's currently making a loss of 10%, and it has a debt of 126%, which is massive compared to making a loss as well. Now, it recently issued an update saying that it has $772 million worth of cash, but when you factor in the debt, it actually has a net cash of $362 million. So I don't think it's going to go bankrupt anytime soon, but it's on a downward spiral for sure, and it is one that I am definitely staying clear of. So number 4 out of 5 here is actually a very popular company in the UK, despite it not performing well at all. And its Epic code is AML, and that is Aston Martin. Now, if you don't know Aston Martin, it is a huge car manufacturer, and it basically specializes in sports cars or luxury type cars. And if we look at their 5-year graph, over the long term, it just hasn't performed well at all. It's currently trading at 47 pence per share, and even at that really cheap price, it is by analysts almost 100% overvalued. Huge. And it has an average annual earnings return over the past 5 years of minus 19.6%. So it's making a loss year after year, and the share price is decreasing year after year as well. It's forecasted to be making a loss as well until at the very least 2023. And then who knows, it'll probably continue on from then as well. It has a future return on equity of minus 9% in the next 1 to 3 years. Now this company, not only all of that, it has a huge debt of a debt to equity ratio of 256%. Now a lot of people love this company, maybe because they love the cars, but when you look at their financials, I just don't see how this company is a buy. So once again, no from me. Now my last one up on this list is in a slightly different sector here, and that is the energy sector, more specifically oil. Now we're looking at a UK company here known as Tullow Oil, EPIC code TLW. Now as we know, there is a huge fight going on between oil, between OPEC, Russia, Saudi Arabia, etc. So the demand at the moment for oil is just not there, but there's such a supply, and all these companies are competing with each other. So some of these companies will go under for the big dogs to come through. Tullow Oil, in my opinion, is one of those companies that will very much struggle. And this company already is struggling. It had a crash prior to the actual crash in 2019. The share price plummeted, and it currently sits at 30p per share, which is 88% overvalued according to analysts. So it's producing negative earnings, it's making a loss, and it's predicted to be making a loss until at the very least 2024. It's actually got a profit margin of minus 100%, which is massive. But wait for it, it has a debt to equity ratio of 312%. So extremely high debt, lots of losses, decreasing share price. It's not looking good for Tullow Oil. So based on these companies' growth history, their financials, and their current share price, they're just not buys for me at all. And I wouldn't be surprised to see any of these going bankrupt in the future. It's very easy to look at a company's initial share price and think, oh, that looks good. But then once you head into their financials and take a deeper dive into the company, sometimes you can see why that is the case. So it's so important to always do research. So I've just listed 5 here today, but I do have a list of some more with very similar financials to these, which I'm also staying clear of. So I may well do a part 2 to this video as well in the future. Now, if you've enjoyed it today or you found it interesting or useful, please hit the like and subscribe button. It really is appreciated. Also, leave some comments down below. Are you holding any of these companies, or are there any other companies that you think are in serious trouble? Let me know your thoughts in the comments. Thanks for watching, and until next time.